Welcome to today's webinar, Why Electricity Costs Continue to Rise in Australia. We've been getting a lot of questions lately, especially since July 1st, 2025 this year. Lots and lots of customers' electricity bills have risen whilst wholesale market prices have been relatively flat for the last 12 months. So just digging into a little bit more information about understanding the key cost drivers behind your electricity bills and what else is associated with these rising costs. So it's been a volatile last couple of years for Australia's energy market. We've seen wholesale energy and network costs risen steadily since 2020. Wholesale energy prices have actually softened, if not maintained a sideways movement over the last 12 months, but business electricity bills still continue to rise. So I want to dig into 7 key drivers behind these changes and what that means for business energy costs. So this is a quick graphic of the New South Wales base futures spot pricing of electricity. So you can see we've had a particularly volatile period in and around 2022, but since July 2020 through to now, you can basically see that in that red, the trend line has been trending upwards, taking it out that really difficult period of volatility there in the middle. So what's causing that? Look, the first driver is aging infrastructure and maintenance costs. So we've got all these poles and wires, the network assets, which have been built decades ago. They're sort of some coming to end of life and requiring higher maintenance costs to keep them powering our homes and businesses. The maintenance and replacement costs of these poles and wires and the distribution lines are accelerating. And we're also coupled with, in Australia, we have extreme weather events. So you think about the floods and the fires that we have on occasion in different states, causing fairly significant swings in cost of energy and also an increase in fixing damage from these weather events. Remote access and safety standards add to expenses. So you think about how far west these distribution lines flow and just simply the accessing these remote areas is simply a tyranny of distance thing, requiring maintenance crews to head out west for days on end and maintain high safety standards when dealing with electricity. It all adds up. And material costs like copper and transformers are also becoming more costly as well, among other minerals. So this is a quick view of the last nearly 5 years of price of copper in US dollars a pound. So again, we can basically see a trend line upwards over this period, which is adding to the cost of our bills. Tyranny of distance. So you think about Australia's vast geography that drives high infrastructure costs. You know, we have longer power lines. This is a graphic of the distribution lines across the NEM. Now, this is relatively eastern seaboard. So obviously you think about these power lines and how far in to the center of our country they go and the sheer number and volume of these distribution lines. So longer lines means higher power losses and reliability expenses. You have a breakdown in part of a line. If it's just a single line going west, clients all along that line will lose power as well. Low population density raises cost per customer. So you think about a lot of our regional remote townships needing high voltage distribution lines to feed the town, but we have a very small number of people in the population out there, increases that cost per customer. And it's simple when you look at transport and logistics for maintenance. It's challenging. We've got to have a lot of trucks on the road for a lot of distance to get the maintenance crews and the equipment out to make these repairs as well. And then obviously land access, environmental constraints add to complexity. So you think about our mountain ranges and lower lying flood areas. Just simple geography causes complexity when either building new power lines or maintaining the current ones. Renewable build out and grid integration. So connecting remote solar and wind farms requires new power lines. So we've got a couple of large scale projects happening at the moment where we're building high voltage transmission lines from the middle of Australia back across to the eastern seaboard where the metro areas are. So you think about the sheer distance of these power lines. Obviously, connecting remote solar and wind farms, we want to build those where your solar farms are getting the highest percentage of sun per day, and hopefully the lowest volume of rain. And same goes for the wind farms. We've got to build these things on higher up on hills where you're getting the best wind and hopefully the least amount of damage from storms and adverse weather events. Grid upgrades for voltage and frequency stability are essential. So if you think about the stability of a grid, when you're building a solar farm, for instance, you're only exporting power into the grid during sunlight hours. And more so than that, it's not a stable supply, a reliable supply in terms of the volume of energy they're producing. Clouds might go over a solar farm for a period of hours and reduce the production coming out of that solar farm. So that affects the stability of the grid. So we've got to upgrade the grid to handle that infrequent or fluctuating supply from these renewable generators. More variable generation means greater balancing costs. So I explained a little bit about that with variable generation. If we have a low wind event where the wind farms aren't getting wind for a period of days, can greatly reduce supply. So we need to back that up by balancing generation as well. Distributed energy, so solar, batteries, EVs, they all add complexity to the grid. So you think about the uptake of rooftop solar, we're getting an enormous amount of energy pushed into the grid between 11 and 1 each day. And that's not what the poles and wires were traditionally built for. And so it's adding complexity to the way the poles and wires are managed and how generation is managed to handle supply. Lots of commentary about the duck curve now, where you have a peak in the morning, peak of load in the morning, and then a dip or a trough through the middle of the day when all of our solar systems are producing, and then another peak of an evening where the solar turns off and everyone comes home from work and the demand, goes through the roof. So the duck curve is a particularly difficult thing to manage. And then massive transmission projects are funded through network tariffs. So all of the costs associated with building, maintaining and operating these poles and wires, we need to make that money back somehow. And that is where you look at your large market energy bill. That little diagram there shows that network costs for this particular customer are 57%, basically 50% of your electricity bill. Now those network charges have been increasing as well over this last period. So if you think about your energy charges, which are really the only variable or the only charges that we can do anything about to try and minimize, the network costs are actually quite a high percentage of all the bills that we're seeing. So if energy charges are maintaining or giving a sideways movement and the network costs are going up, there you can clearly see how the cost of power is going up for businesses as well. Driver 4, construction and commodity cost inflation. Steel, copper and other equipment costs have surged globally. Construction and labour costs, we all know, have been going through the roof since COVID. And no difference between constructing a an office building as there is to constructing a new high voltage power line. It's all construction and labour. So all of those costs are going up as well. Financing costs, obviously, interest rates have been a big driver of increased pressure on construction. Currency fluctuations and shipping costs also add pressure with the low Australian dollar at the moment. And then insurance and compliance costs for infrastructure are obviously on the increase as well. Coal and gas plant retirement. So obviously the plan is to close all of our coal-fired plants like Liddell and Eraring. So that's going to tighten up supply. You think about the size of these coal generators and the amount of solar and wind we require to be constructed to replace that supply. It's going to be quite a big job. The aging plants are less reliable. So of course, if these plants are set for closure, they're not going to replace entire sections of it with new equipment. So they're really just trying to maintain the current working plants until they're mothballed in the coming years. Gas peakers fill the gaps in the drop in supply, but it's also expensive to operate. Supply scarcity increases price volatility and risk premiums. So obviously you think about supply and demand curves. As we lose supply, you would expect demand to stay steady. We're going to see increasing costs. Now, a lot of that is already priced into the market. We've known these power plants are shutting down for quite some time. So the market has priced in the fact that these will be closed, but who knows what will happen post 2028 and beyond, where we actually see these plants closing. Ancillary services like FCAS now carry a higher market value. So we've talked about this before in our webinars. You'll be able to find a video on our YouTube about how the FCAS market works, how businesses can generate income from a large-scale battery on site, trading under that FCAS. And obviously those batteries operating in that FCAS market are to help with the future of our grid in terms of stabilizing voltage, as well as helping to stabilize supply during peak demand periods. Driver 6, demand growth and weather extremes. So the terminology electrifying Australia is quite public at the moment. Obviously a lot of incentives for people to put in heat pumps and EVs, and that's just adding further demand to the electricity market. Peak demand is growing during extreme heat events. More people have air conditioners, more buildings have air conditioning as well. So that peak demand period's usually early in the morning, late of an afternoon. As we get extreme heat events, equally with extreme cold, people are using their heaters and people are using their air conditioners a whole lot more, growing that peak demand. So a peak in demand for a very short window is actually a very difficult thing for the poles and wires to cover, because you need to have the ability to supply all of that required energy, even for a short period of time. So it's essentially overkill for the balance of the day. Networks are built for rare peaks, increasing costs. And look, shifting demand profiles complicate grid operations. I touched on that briefly with the duck curve. And businesses with daytime loads face higher energy rates. However, the uptake of rooftop solar has assisted with those costs quite substantially. Regulatory and market design factors. So network revenues are regulated returns on capital. So we need to make that money back on building, maintaining, and operating the poles and wires. So regulatory resets raise allowed income for networks. So that was that 56, 57% network charges that we discussed earlier. tariff reforms shift cost recovery to demand-based tariffs. So we've actually seen quite a lot of network tariffs have changed as of July 1 this year across a number of distributors. Those network tariff reforms are penalising large peak demand energy users more than smaller loads or more steady loads during the day. Retail is building hedging and risk premiums. So we're obviously, a lot of what we've seen over the last couple of years is premiums associated with, we believe the supply of energy is going to drop when these power plants close down. We need to hedge and factor some of that risk in now, and we're seeing that in pricing. And then policy changes and environmental levies raise costs. So environmental levies for the construction of new solar and wind farms, obviously. What can businesses do? Reviewing tariffs annually to ensure correct network tariff classification. This is a huge one right at the moment, since we've had such a big change in network tariffs recently. This is an example here of a saving we generated for a client. They were paying roughly 55 grand in distribution costs purely by changing their network tariff. We were able to knock back a significant portion of the demand in that tariff. So they're on a time of use tariff, and we just moved them back to a standard tariff. So 13.5 grand in savings on a 55 grand. Works out at 25% saving, 24% saving, purely by doing a network tariff optimization and network tariff review. So obviously installing solar and batteries to cut peak demand exposure. We all know about rooftop solar. The entrance of the cheaper home battery scheme is doing great things for smaller businesses to install up to 100 kilowatt hour battery to take on some of that peak demand shaving, or further reduce your peak loads during that evening peak period. Exploring long-term PPAs, power purchase agreements for predictable pricing. So there are PPAs available in the market for larger businesses that can give you, up to 10 years of energy prices that you can lock in. So that's a great way if your business is requiring predictable pricing. Participate in demand response programs if eligible. So there are a number of different programs here that you can participate in, but interesting things like demand response. If we need to drop demand in the grid at any particular time, you might own a portfolio of pubs. Perhaps you can turn your cool rooms off for a period of 30 minutes or less. If you can turn them all off at once, that drops the load in an area significantly, and you can get rewarded for participating in that program. And then obviously a shameless plug, working with brokers to benchmark and negotiate energy contracts. So we try to keep our customers updated on what their pricing looks like up to 2 years in advance. So giving you plenty of time to understand market movements, where the market's headed and why, and how you can better plan and strategize, locking in power prices that can incrementally improve your situation. The key takeaways: Australia's energy landscape is shaped by these 7 structural cost drivers. Network and infrastructure costs certainly been dominating the current price increases in recent years. We can expect continued rises as renewable integration accelerates, although we are hoping that once we're up to a certain point that we should be able to see a reduction in these power prices. And then obviously proactive businesses can mitigate exposure and stabilise bills. So I hope you found that interesting today. Nice, short and sharp one today. And please feel free to reach out if you have any queries.